Howdy, Jacob here. Today we're looking at NVE Corporation in the semiconductor and equipment industry with under 400 million market cap, slightly lower enterprise value. We do like to look at insider ownership for smaller companies, and we do see only 1.3% held by insiders. So again, that doesn't necessarily mean good, bad, ugly. It just is one of the statistics that I like to look at for smaller companies to be more confident that what I'm investing in, the management and board are going to do what's best for me as the shareholder. And with that, you just aren't as confident that they're going to do the same. So you definitely just have to do your research, buy it at the appropriate price that makes sense to you. I mean, in all investment decisions, you need to buy it at the appropriate price. But again, it's just being more confident that management's going to do what's best for you as a shareholder, as they themselves are shareholders. So that's just the pointer, not necessarily, again, good, bad, or ugly, just what it is. Slight increase in revenue. It actually decreased from 2018 to 2021 fairly substantially, about 30%, but is now up almost double in the last 2 years. Very substantial growth recently. But we do know that the semiconductor industry is a very cyclical business, and the most recent 2 years have been very explosive for semiconductor companies. And then on the margin side, huge margins, 80% gross margin with 60+% operating margin. So very little goes into in cost perspective. Like as much cost goes into cost of goods sold as R&D, sales in general. That's a very impressive figure. So we do see 8 million up here with in cost of goods sold, 6 million, 4 million with 5 million, 4 million, 5 million on R&D and sales general and admin. So it doesn't take a lot to run this business, and they just spew out a plethora of profit. As low as $2 earnings per share, but has increased to $4.70, with their dividend paying out 100% of it, and historically actually has been $4. So I wonder how they've been able to afford that. We'll see. There's no debt on the company, so if they haven't been issuing debt, I say that because their return on equity is the same as their return on invested capital. And also, if we look at their balance sheet, no short-term debt, no long-term debt. And it looks like it was actually due to their short-term investment declining. So they used their, they divested into some things, divested out of investments, or they reduced investments to fund this dividend, which they shouldn't be doing. I mean, again, it is I don't know if it's again, what was their yield at? 5%. 5% yield is pretty big, is a pretty big payout for a company that's historical return on invested capital has been at least the teens and is currently in the 34%. I would definitely want this company to be buying back shares that are stupidly cheap, and then especially reinvesting back into themselves, not selling off investments. And so the very first thing that I'm going to do is say, why are they paying out so much in this dividend? Let's cut that at least in half. Now their dividend payout on a 5-year average basis is probably in the 50 to 60% range. Again, you have to balance out what you want the company to do with what they've done historically. Historically, they've paid a lot in dividends. Will they likely cut it? Probably not. But to me, again, it's a balance. I want them to reduce that dividend so they have other things to do with that free cash flow. And with that, that leaves about 40% of free cash flow available. They haven't historically bought back shares, but I'm going to assume through acquisitions and reinvestment, they're going to be able to grow at 5% a year. Again, it's a cyclical business. So maybe in the most recent year, it's grown so much in the recent years, it's maybe a little sluggish, maybe declines a little bit. But I think 5% a year over the next 7 years seems pretty reasonable to me, with margins around, let's do 56, 52, doing a larger range there. PE, I mean, cyclical, great return on invested capital, but again, they don't necessarily reinvest everything back into themselves. What I like to say is for your terminal PE and price to free cash flow, you need to look at two big things, growth and moat, I guess. So growth here, I think, is relatively average, relatively in line with the market, maybe a little bit higher. And so historically, PE has been that 15-16% range, 15 to 16 range. But then again, their return on invested capital is higher. Their ability to reinvest back in themselves is greater, but they've historically not used their cash to do so. And so if you do have a business that reinvests back in themselves, becomes more efficient with the cash, incremental cash that they're gaining on free cash flow and earnings, then I think the earnings is deserved as well as consistency. there's a lot of different things that go into what your this is the art of investing with your P and price to free cash flow. But to me, I think 17 P makes sense to me. I think that growth is a little bit great in the market. I think their ability to reinvest is a little bit great in the market, but not so much that it deserves an excess premium. And I do think the semiconductor industry is pretty diluted, and I don't see them owning a lot of it. And then with all these assumptions, we get to a price needs to fall 43% to get to the return we're looking for. And to me, I think that's reasonable. I mean, they're paying such a high dividend right now; they're not reinvesting that much back into the company. With the return on invested capital as high as this company has, I would want them to reinvest back in themselves to get extensive rate of return, make the company more efficient, and increase the value as a shareholder. Which, giving a dividend can be great for some people, but for the average person that's not retired, that doesn't need that free cash flow, they just want the business to grow to its maximum peak value. And to me, that would make the most sense by reinvesting into themselves. So hopefully you enjoy the video. Have a great rest of your day.